There is a financial system running in the background of your life, a silent operating system that the wealthy understand intimately and use every single day. You were never taught it. You were never meant to use it. In fact, most people have been actively steered away from ever seeing it. But here's the thing. Once you truly understand how it works, you can't unsee it. In our last video, we exposed how owners and workers are playing by two fundamentally different sets of rules. Here is the part the gurus won't tell you. The tax code was not designed for workers. It was designed to reward owners. The minute you cross that line, even with just one rental, you aren't just a landlord. You're playing a completely different game. Today, I'm handing you the owner's playbook. I'm here to show you the almost invisible system that the wealthy use to not just get rich, but to stay rich forever. They compound wealth beyond what most people imagine is possible. When you combine this playbook with one specific twist in the tax code we're discussing today, you unlock what I call the Zero-Tax Snowball. This is a system that lets your wealth compound faster than the IRS can tax it. This is part 2 of my series meant to expose this entire machine. If you want the full blueprint, hit subscribe and that notification bell right now. The core truth: wealthy people get wealthy by not selling. They don't sell the assets that make them money. They leverage them to buy more assets. It's a cycle that never resets. While most families are trading time for money, wealthy families are using businesses, stocks, and real estate as a perpetual motion machine. Now, for most of us without millions in the bank, there's only one real entry point: real estate. It gives you cash flow, leverage, appreciation, and the big one, tax advantages you can't get from a paycheck. Let's look at the worker mindset versus the owner mindset. Scenario: you buy a single-family home for $400,000. It's making $300 a month in cash flow. You're getting depreciation, which is the IRS allowing you to write off the value of the house as if it's wearing out, even if it's brand new. Fast forward a few years. That $400,000 house is now worth $500,000. The worker mindset says, I've made $100,000. Time to sell and cash out. The result: you sell. You get your check. But then, Uncle Sam knocks. That $100,000 profit is a capital gain. The government takes 15% or 20%. Suddenly, your $100,000 is $80,000. You've lost your asset, you've paid the fee, and your wealth journey just hit the reset button. You're playing a game where every time you score, the referee takes a cut and sends you back to the starting line. Here is how the truly wealthy handle that same $500,000 house. They never sell. Instead, they borrow against it. Write this down: borrowed money is not income. Because it's debt, it isn't taxed. Let's look at the numbers. Original price, $400,000. Original mortgage, $320,000. Current value, $500,000. Current debt, $280,000. A lender will let you do a cash-out refinance up to 75% of the value. That's $375,000. You pay off the old $280,000 loan, and you are left with $95,000 in tax-free cash. That money flows into your bank account untouched. You didn't sell the house. You still own the asset. And you have $95,000 to go buy property number 2. This is the borrow until you die strategy. It's why Mark Zuckerberg takes a $1 salary. He doesn't need a paycheck. He has stock he can borrow against. For a long time, this felt exclusive. But this year, the game changed. Enter the one big beautiful bill. While the news was arguing over politics, they missed the biggest wealth-building unlock of the decade. It didn't just bring back a tax break, it delivered a supercharger. In episode 1, we talked about short-term rentals. If you own an Airbnb and you materially participate, the IRS treats it differently. You earn $100,000 at your job. You owe $20,000 in taxes. You buy a $500,000 street. You do a cost segregation study. You generate a $125,000 paper loss. That $125,000 loss wipes out your $100,000 income. Your tax bill goes to zero. That $20,000 you were going to give the IRS, it stays in your pocket. You use that money to buy the next property. Cash flow grows equity. Equity unlocks tax-free borrowing. Borrowed capital buys more assets. More assets create more deductions. That is the zero-tax snowball. It's not illegal. It's the system. And now that you see it, it's time to use it. Here is the hardest part to swallow. For your entire life, you've been told that debt is a danger, that taxes are a certainty, and that the only path to safety is a steady paycheck and a savings account. But look around. The people telling you that aren't the ones winning. The wealthy aren't smarter than you, and they don't work harder than you. They just have a different set of permissions. They have permission to use debt as a tool. They have permission to treat the tax code like a menu, not a bill. And today, I am giving you that same permission. The zero-tax snowball isn't just a math trick, it's a border crossing. You are moving from the world of selling your time to the world of owning the system. The system was designed to keep you on the treadmill, but the one big, beautiful bill just gave you a ladder. It's up to you to climb it. I'll see you in the next video where we start to climb. Don't forget to like and subscribe.